Okay, we are live again. Welcome, welcome. Give us a few seconds to let everyone in the room. Let's hope this Spaces is going to be kinder to us. Welcome back, everybody. Welcome back, everybody. Thanks for rejoining us. Hopefully, we're going to have a much more forgiving technological experience. Welcome back, welcome back.
To maybe make the co-host.
Yeah, coming up. You should have co-hosting rights, Carl. Let's get Connor up here. Carl, do you hear me okay?
Yep, all good.
I don't know what's happening with technology today on your side. Is it just us that's cursed at Commonwealth?
You can hear me, yeah?
Yeah, I hear you. I hear you.
Okay. Seems like this time's better this time around here.
Okay, great. We've got one more speaker on the stage who didn't introduce himself last time, so let's invite Coach K, I think, to give us a brief background and say hi, and also why he thinks this topic is interesting. Coach K, if you'd like to come in.
Hey guys, thanks for inviting me. That was a really weird technological experience. Those who don't know me, I've been working in the space for about 7 years full time. Started off more on the education side, then realized I'm quite good at marketing and tokenomics, and started focusing a lot more on that side. I think numbers came to me because I'm also a trader, and so numbers kind of speak to me, and they have to make sense for me to understand everything, and so. Um, I've run a DAO since basically when I started in the space. So it's been about 6.5 years or something like that I started my own. It's probably one of the oldest ones in the space, if not the oldest. And Commonwealth resonates well because it's basically what I do with my DAO. So we basically, give opportunities for people to come into projects. Obviously, we don't do everything for them because we're not technically a fund, but I kind of train people to think as if they're their own fund and coach them up, which is where the Coach K comes from. So that's just a little bit, also known as a KOL to some of you guys. And yeah, I love building and I love the space. And obviously, giving the average Joe a chance to be a millionaire is kind of what I love about this space. And then helping them get beyond just thinking about the money and helping them realize there's much more to life when you have some money, and to focus on those things versus just focusing on capital and stuff like that. And yeah, so it kind of resonates really well with what Commonwealth's doing, and it makes a lot of sense to me, and I'm sure to a lot of other people it'll make a lot of sense as well.
That's great, Coach K. Thank you very much. Yeah, resonated with a lot of what you said there. That's brilliant. Just as we're getting the speakers up on stage, I think let's dive right into the first topic of discussion. For those of you just joining us, welcome. This is the very, 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 very first All Street Beat. And we've procured this, we've produced this together with DGen Spaces. They're absolutely brilliant. You've been in touch with them via our Twitter channel to be invited to the spaces, and I hope we can bring something valuable today to discuss. What is the future of retail investment? How does it look? We've all been through at least one, maybe two, three, four different cycles in Web3, and each one looks slightly different. So if you look back, you would have seen quite a lot of evolution in how investment is done in Web3. And when you look forward, how does that look? What is the next um, iteration of investment in Web3? How do retail interact with that? Do they continue to come in later into investments and sometimes become sort of the exit liquidity for people who've come in earlier? Do they continue using launch pads? Do they just not invest at all? What is the future of Web3 investment? So we're calling this the retail revolution and rethinking investments for the 99%. So let's dive right in. I suppose the question I want to ask the panel is, we're in a new technological kind of era, a new phase. We've got a lot of developments on machine learning, artificial intelligence, algorithmic based interactions with media, with technology. We have, of course, the decentralization movement. We have Web3 technologies. You know, what, how can we leverage all of this to change or improve how investment is done? And ultimately, the purpose of investment is to make profit, is to win, is to gain, is to become, wealthier than you were before. So how do we leverage all of the opportunities that are provided by the context we're living in now to be able to do this better, to profit better as individuals, as institutions? So, I suppose let's focus on the retail here. And I'll put the question out. Whoever's ready to answer the question, just come in and just say, within this new technological era we're in, how do we leverage that for the better of the individual in terms of investment? Who would like to go first on that? Just unmute yourself and come in, and then we can invite one by one everyone else to give their opinion.
Yeah, I think I'd love to take that because I think the reason why meme coins do so well, going based off of what you were just talking about, the reason why they do so well is because they're fully distributed. Everyone has the same fairness of getting in. There's no pre-sale, and everyone has the same opportunity as each other, which is why you're seeing more liquidity going into meme coins than other coins. And I think retail's kind of woke up to the fact that, if a VC gets a private sale or a seed or a pre-seed or however many rounds that they have with lower and lower and lower prices, that they're the ones who are basically the exit liquidity unless it's in a bull market when everything's going up. And the best way to protect people from that is basically educating them, teaching them what tokenomics are, teaching them what distribution schedules are, helping them understand that if you give 5% of your tokens and there's 95% dilution coming, that those first 5% are going to be the most valuable 5% unless the project is a success. So understanding all that and understanding how it affects the projects, because it negatively affects them because it's a lot of sell pressure right away. If you moon really hard, you're going to have sell pressure every single time you get a distribution. And who is the one buying it? The retail guy. And then they're actually the ones who are getting left with the bag because they're the one thinking it'll come back, but there's another distribution cycle. Oh, it'll come back, but then there's another distribution cycle. And the price continues to go down until it levels off. But that could be a long time and a very painful lesson for retail. So to help them understand that, and then giving them opportunities, which is why I have a DAO, right? I want to give them the same opportunities as everybody else to get into projects. So I put it out to them, and if they're interested as a group, they will vote to say yes, we want to go in, and then we'll go in with it. Commonwealth does it even simpler way because they actually take on the fund management side for people. And that's what I really like about it. It's like they don't have to think about it; they just know that the people that know better are in charge, and they're going to make good decisions with the community as well. But it's fair, and I think that is the difference between why there's great legitimate projects with zero liquidity and why there are meme coins with multi-millions of dollars of liquidity through the whole entire bear market.
Yeah. Okay, Coach K, that's brilliant. Intervention. Education, prioritizing education is absolutely paramount. Using technology. Is there somebody from sort of let's say less degen crypto in terms of like communities and a bit more sort of traditional or legacy in the audience right now, or in the audience on the stage, who would like to open their mic and just speak how they see the future of retail investment going in this new technological era that we're in. Like, how do we improve things going forward? Who would like to speak?
Yeah, I can jump in here quickly just to talk about kind of the evolution of what I've seen kind of in the market and what I think is going on. I think this kind of like everything is still early and the tools are kind of being built out where uh, the most important thing is that blockchains to give like equitable and transparent access to market information, but people may not really like get that or have that information. But I think the tools around that are kind of improving all the time, where you can go to like token unlocks and see vesting schedules, token economics, and understand exactly how the mechanics are. So the fact that it is increasingly out there and transparent and it kind of is all available on the blockchain. It just means it's going to take time to get all this tooling to a place where it feels intuitive to everyone and it's easier to understand. But I think we're kind of on that path. And ultimately, when you think about the tech, it's really great because this is kind of a unique place where, a 15-year-old can be on the same a level playing field as a sophisticated institutional actor, in the sense that the information that you have on the chain is very similar, and you have all the same tools to get that. So I think it's also like a process that we over time like get better and better at, to really like make it so that the information is out there, and it's out there in a way that people can understand.
Brilliant. Yeah, fully agree with that. Is there someone else who would like to take a stab at this? You've heard from Coach K, we've heard from Access now. Um, is there anybody who has a contrary point of view on this? Yeah, Didi, come ahead. I saw you open your mic. Go ahead, sir. And also,
Yeah.
please if you haven't spoken, just introduce who you are so that the viewers or the listeners even have a chance to meet you.
So thank you for inviting me. So for the ones that don't know who I am the guy that is the perfect example of the evolution of the retail revolution of investing. So we went all in after selling our house a couple of years ago, let's say 7 years almost now. And I think that's a perfect example how we as a family were one of the first retail investors that were able to monetize the new digital revolution of currencies. Because if we would have used our bag and gave our bag to the banks and trusted them on their return on investment of 6 to 8% a year, we would have never reached those steps that we reached now as a family. So for us, going all in into Bitcoin, which was of course the first currency out there, was again giving normal people like me access to the new era of digital currencies, which gave me a return of investment that was way higher than other could have given me. And I think that is exactly the evolution that we are seeing now. We are seeing that people are getting sick of all the centralized entities trying to manage your capital in a very bad way to fill only their own pockets. And more people are understanding now, wow, we can manage our own capital and live this beautiful life if we do it in the right way. And I think that is Commonwealth is one of the examples. If that would have been there 7 years ago, it wouldn't have been that emotional roller coaster ride for me and the family that it was at the moment. So I think it's a perfect timing for Commonwealth to come in to support all those other, retail people that just don't have enough knowledge yet, but that do want to take a risk in increasing their capital. So that's the only thing that I can tell about it at the moment.
Didi, you mentioned something there about the sort of the pain and the friction and sort of the roller coaster ride you experienced in trying to navigate these new opportunities. Have we come further? Is it now better? I mean, maybe you can speak a little bit more about that in terms of how you've seen things change in the few years that you've been experiencing this.
So, in my opinion, the issue at the moment is that everybody thinks, young people as well, that come into the space, they think that they will be the best trader and will make the most profits and do the best investments. Now, to be very clear, I thought exactly the same in 2016 and 17, because I thought, I will trade the fuck out of this bull market. That will be beautiful. But to be very honest, that's the same comparison that if you start playing football today and you think that you can play the Champions League tomorrow. That's impossible, because you will enter a league where people are with a lot of experience. They exactly know how the investment world works and exactly know how to trade. And you are competing with those people, and then not even talking about all the bots. So that's an illusion for the most newcomers, noobs in this industry, that they think that they can compete with all the number one traders and investment funds. So I think it's very important that there is this of Commonwealth, that what we are creating now is that like we are now being able to join some very interesting projects that have way more quality and knowledge on how to enter the market, how to trade, how to invest this market. So I think it's more protection for a lot of noobs that will probably make the same mistake that I made in 2017, 18, 19, thinking that I was the number one Messi of trading. So, yeah, I think it will save a lot of people, a lot of roller coaster feelings from ups and downs and selling on the wrong moments and buying on the wrong moments and all that stuff.
Is there anybody on the panel right now who would be sort of more representative of the ones who are already in the Champions League? You don't have to call yourself a Lionel Messi, but at least somebody playing for one of the lower Italian teams or something like that. Is there anybody from a VC on the stage who would like to just to speak how they experience the retail investment landscape right now, or even just the investment landscape? I think there's Lisa's just arrived on stage. Evan, why don't you go for it and just remind everyone who you are, and then we can invite Lisa and the new speakers to speak.
Yeah, for sure. So yeah, I'm Evan. As I was saying before, I work at Outlier Ventures, and we're an early stage accelerator, so quasi venture capital, I guess. But yeah, I definitely think it's a good thing for retail to be able to get into the same deals as the bigger VC funds, or in the early stage deals at least, because the discounts you do get on like private sales or pre-sales is a lot lower than what it is sold for the public sale. So being able to kind of get into those earlier, it's a lot better, especially if you are doing kind of more of a fair way with the allocation or the fund that you do have, and kind of pooling capital together so that the everyday investor can get into the same kind of thing. But at the same time, it is very very high risk. I think a majority of VCs, don't make money. Like I think 100 or 110% or something like that of any VC's returns is from 10% of its investments. So especially when you're doing extremely early stage, you're essentially just kind of like spinning the wheel. There's a lot of different kind of data points you can look at. You can go off of like the vibe of the team and all that sort of stuff. But at the end of the day, a lot of the investments you do make in early stage is extremely high risk, and it definitely isn't something that you should do if you don't have adequate capital to do it, or that if you can take the risk really. But if you are able to kind of de-risk it by, joining a DAO and pooling your capital together with a bunch of other people, and that definitely is a good way of doing it. But on the other side, when you have like not as much information as a VC firm would or does, or the same level of expertise, there is definitely like a higher risk of those investments not going all the way up. But the good thing about DAOs is you have the wisdom of the crowd model, especially for investment DAOs, where you can get access to, I guess, more deal flow. But at the same time, a lot of that deal flow that the everyday person gets is very different than what a well-networked VC or fund would be getting. And there still is that bad look that some people feel when they do have to go to, I guess, like Kickstarter-esque things, or like something like Cedar or something like that to crowdfund money. A lot of VCs do not like that and think that's kind of like the last ditch effort. But if you're able to kind of create a successful investment firm or VC DAO fund through allocation of everyday retail users and get a same level of quality of deal flow, then that would be amazing.
I want to just kind of switch the direction up and kind of ask a question here to all the panelists. What do we feel is the future of what is considered to be a tier one VC? Because traditionally it's been determined by typically how much assets under management a fund has, and this is how we kind of calibrate. Okay, this is a tier one, blah blah blah. But I kind of have a belief, and this is, I think, a feeling shared by Commonwealth, is that perception of what a tier one VC will be is more about smart money and how much value might be added by the people writing the check, right? So if you have, one big VC writing a $500,000 check, or something like Commonwealth coming in, which that check that comes in is represented by tens, hundreds, thousands, maybe even millions of people one day that now have interest in seeing this thing succeed. I mean, you're going to want Commonwealth on the cap table every time, in my opinion. And when I say that it's represented by everybody in Commonwealth that's holding wealth tokens, that's the beautiful thing about the way the economy is designed in Commonwealth is that it doesn't matter if you're invested in a fund or not and you're directly profiting off of the results of the fund. Value being created is always being redistributed back into the token ecosystem, increasing the value of the market cap if value is created. And so even though you might not have direct exposure by investing in one of the funds that is investing into these projects, you have secondary or indirect exposure to the success of it. And so everybody who's holding wealth tokens, staking it, participating, has a vested interest in seeing these things succeed. And that's how you get a lot of eyeballs onto a project. So I'm just curious from panelists if they share a similar opinion on kind of if that definition of a tier one VC is being redefined. Let's also not forget that we all thought Alameda and 3AC were tier one investors last year. And that obviously didn't prove very well. So I'm just curious anyone's thoughts on this.
Hey, Kyle, before we put that to the panelists, I realized we had a bit of a glitch at the start of the spaces. We had to go to a new link. So a lot of people might not have been able to make it into the spaces yet. If there's anybody on the spaces, the panelists, or in the audience who have community that would be interested in this discussion, would you please just mind tweeting out, say, hey, come join us on this in this discussion. We're discussing the future of retail investment. And if you want an easy ask, just go to Kyle's Twitter. He's just posted that. You can quickly just retweet Kyle's tweet. That'd be great. Let's try to get a lot of people in here so that we can make this discussion valuable for the 99%. But yeah, great question, Kyle. I think let's get a new speaker in here. Lisa, you haven't spoken yet. Would you like to introduce yourself and also just take a stab at Kyle's question? He's asking if the current VCs are still fit for purpose, or is there something changing?
Yeah, so a little bit about me. So I've been in crypto since the very beginning. I've been a trader for 25 plus years and, trading crypto since it's been tradable, which was about 2012. Seen like all the market crashes, all, the stuff happened with Mt. Gox, with Quadringa, with, obviously FTX and all of that sort of stuff, Luna. I can't remember the guy's name. The was that guy. Anyway, BitConnect, that's it.
Carlos.
Yeah, so, the ups and downs of crypto. So, we've got to remember this is a very, very new industry. There's going to be people coming and going and, dipping their toes in and sort of going, okay, is this for me? Is this for long term? Is this the way that money's going to go in the future? And having that sort of, experience that, sometimes it doesn't go right for them. And, these are big companies sort of coming in where we've seen, like MicroStrategy, where they've got some sort of strategy where they're, DCAing and buying Bitcoin at sort of, the highs, which is kind of random. But, with you saw FTX and that sort of stuff, they were kind of like young kids out of high school, almost out of university, and just going in and being really reckless with money. And, when you get to those sort of highs and, nobody's there to really sort of pull you in and take control of that, it just gets really out of control. And that's kind of what happened here. And, with big companies with protocols and that sort of stuff, where you see, some of the larger investment firms coming in, they're not making these crazy big decisions like we saw with Alameda. So, it's coming into regulation period. I know that's like a nasty word in crypto, but to a certain extent, a lot of these companies do need some sort of regulation. I'm not all for the huge regulations that they want to put in, but I do think there needs to be some sort of regulation that people coming into the industry are not going to get completely burnt and then rugged and, end up with nothing. And then we don't have a market anymore. So we need to have that sort of thing moving forward. And I think, this change with VCs and with how they're sort of doing business and what they're looking at is a really good thing.
Great. Thank you, Lisa. Thanks a lot for that. Um, who would like to sort of take a stab at giving us their views? We haven't heard from everyone yet. Kyle asked a question. He was like, okay, guys, what is it these VCs have to offer? And I think Evan did a really great job of like really kind of clarifying, what a traditional VC does, why they're considered, to be a safe pair of hands, to use the analogy that Didi brought up, why they're in the Champions League of football or, the professional sports, and the rest of us are just trying to, sort of in amateur leagues, trying to craft out some kind of value or trying to craft out some returns. So, I suppose the question is, what is it that, VCs are bringing to the table in the future? Is it just that they're conveniently somehow in this, network, which was spoken about by Evan? Evan also mentioned that a lot of the investments don't go well. So, like, what is it that VCs are able to do to control how the investments go? What is the value add, and how does that look going forward? So is there someone else who hasn't spoken yet? I know there's quite a few speakers here who haven't spoken. So just unmute yourself and come in and just introduce yourself and tell us what you think about the future of the retail investment and investment in general in Web3.
Yeah, hi. This is David.
Hey, David.
Yeah, do you hear me well?
Yeah, 5 on 5. Go ahead,
Okay.
David.
So I'm currently a venture partner at Greenfield. I'm also advising startups and Web3 companies in the space via my other vehicle. I've been ex Binance, running BD for the NFT marketplace, and I started my career prior prior to the millennia as a VC. So I have I would say quite a longitudinal perspective on VC, and it feels quite different, if I may say so. So, well, commonalities on the one hand is, for me, the traditional VC model back in the old days from Web 1 and Web 3, as I see it today, I don't see like a lot of differences. The only innovation that I see in the VC space these days is in the venture DAO space, investment DAOs that actually kind of make it in such a way that the GP becomes the LP and the LP becomes the GP, providing much more value. So this is one thing that I see, that Web3 is definitely changing with regard to the VC model. The traditional model, as VCs invest, in my estimation, today in the Web3 space, is pretty much similar to Web 1, and also the .com burst, which I saw. It feels like yesterday for me personally. I must say that the same madness of driving inflationary valuation up, it's the same psychology, to be honest, and it's quite disappointing. And so I feel like VCs need to be way more financially disciplined. The only problem is that we have so much money in the market due to quantitative easing since 2008. There's, like, in Europe, I don't know the US numbers, but in Europe, there's like 14 trillion euros in money from 3.4 trillion in 1999. So there is a 3.5x in quantitative easing, monetary supply that has increased. So it's just too much money chasing few good deals. And that hasn't changed, right? So I would hope that VC going forward is getting way more financial disciplines, looking way more at intrinsic value, and way more less at meme coins, which do not simply provide any utility at all. So those are my 5 cents on the current model.
David, that's brilliant. Thank you. But can you just shed some light? You seem to have been around the block when it comes to investing, if you don't mind me saying. Can you just share some light on what, if there's a lot of money and, limited supply of good deals, what is it that we're looking for when it comes to finding good deals to invest into?
What is it we're looking at? So what are the criteria we should be looking at is how I would kind of look at it. So number one is, and this is something that might differ from other VCs, but I'm trying to look at companies which solve a problem that might not be even visible in the first instance, in a non-trivial way. So often we just don't understand what the real problem is, and then we just chase after a certain technology or a stack or a bridge or something like that. So for me, it's and then the timing. Pair that with timing. Those two issues I think would be the most important, and of course the management team that everyone will just say this is the biggest factor driving success. So I think identifying a problem with a solution and solving that in a very non-trivial way, I think is the most important fundamental issue that I personally take a look at.
And David, just before I bring Bridge in, because I see the hand is up there, do you think that it's only VCs that are able to do due diligence? Now, it's a bit of a leading question in some regards, but what do you think about doing due diligence in different ways and scaling due diligence?
So I think that actually the investment DAOs, I'm not an expert in this, but the way they bring in a lot of experts, just from a sheer number perspective, and actually bundling people around a specific purpose and a specific domain expertise is a brilliant model. So I think VCs nowadays, especially in the Web3 space, it's so broad. You have to know DeFi, maybe GameFi, tokenomics, DAO, governance. There's so many different things that you need to understand. It's very, very broad. I think the domain expertise is just really impossible. Then you have to stretch and build teams within VCs to actually run it. And so I think the investment DAO model has a lot of merit, where you basically have more people around a specific domain, and then you gather those domain experts along a certain topic. And so I think that is a very powerful model.
Brilliant. So, David, that's been brilliant. So you've given us some insights there, but you've also sort of seen the evolution of legacy investment really just copy itself and just be reapplied to Web3 and the decentralized investment movement. But you have also spelled out a couple of small innovations which you've seen, but it sounds like you're ready for more innovation as well. So if we can bring in Bridge, your hand's been up. Thanks for being patient, and just give us your thoughts on the topic so far, and then we can switch gears to another train of thought, another question. But go ahead, Bridge, introduce yourself, and then tell us what you think.
Sure, absolutely. Thank you, firstly, for inviting us onto the space, and congratulations on the first episode of All Street Beat. I think it's been super fascinating so far and a pretty strong turnout. So congratulations on that. So my name is Abby. I'm an investor. I'm a builder. I've been in this space for close to 4 years now on a full-time basis. I was initially onboarded to the space through NBA Top Shot, which I think is one of the coolest projects to date in terms of onboarding retail users into the space. But here today I'm representing Bridge Mutual, which is a decentralized coverage platform that lets users purchase or underwrite insurance for crypto assets, decentralized protocols, and various other centralized services. For instance, hacks, bugs, exploits, rug pulls, and pretty much everyone within the space to date has probably been a victim of one of those malicious activities, particularly if you are a retail investor particularly on your first few investments in particular. And from our perspective, I guess from looking at more from a security point of view, VCs are able to have the additional risk of diversifying their assets in multiple different opportunities. As you mentioned, that they have a lot of money which they're looking to invest into different projects, including ourselves. So for instance, we're VC backed by a couple of different firms, and we're also raising at the moment. So if any VCs here are keen, please do reach out into the DMs. But I think in terms of how insurance in particular and security has an impact on retail investing, it definitely helps that when it comes from a regulatory perspective, insurance can help bridge the gap between just to create a more secure and compliant crypto investments to help that the environment in general just allows for people to be less concerned about the risk associated, because there's an additional vetting process, particularly what we're seeing with meme coins in the past, where many of those succeeded. For instance, the likes of Pepe and a couple others. Then thousands more came up the day after, and being early on projects like this is super important. But for someone to drain the liquidity pool is something that happens super regularly, particularly with these meme coins. So, having a pool available on a platform like Rich Mutual allows you to avoid the additional risk that may exist. So, for instance, if you get wrecked, we would be able to support you with the investment which you put into the pool and the coverage policy which you purchase. That's how we look to help users, particularly retail users, on try to mitigate the risk of investment so that they are able to compete with, to some extent, with similar to VCs where one deal would wreck them, but they're able to diversify their assets across multiple different
Okay.
genres, etc.
Thank, That's awesome, David. So there you got a real kind of innovation in terms of being able to manage the risk better. Indeed, what you've spelled out, I think, is really important, and maybe one of the reasons why so many retail investors face a lot of problems is that they're kind of forced just by the way the access works to deploy into if it's on a launch pad, there's one opportunity that they've been kind of marketed to, and it's like, hey guys, this is going to be the next big thing. And if it's not the next big thing, if it is a malicious kind of scam, or even if it's just hitting bad market conditions, or something didn't go well, a retail investor is kind of it's like maybe not all in there, but they wouldn't necessarily have the opportunity to diversify across a large portfolio, nor would they necessarily have the tools or the education to be able to do that. So you pointed out some really interesting barriers there. So very good. We've got two other speakers on the panel we haven't met yet. So I'm going to ask, before Noah you come in, I'm going to ask Oscar. He's been patiently waiting there. Oscar, what are your thoughts at the moment with regards to how far we've come in terms of investment, the opportunities that are available for let's say retail investors, the smaller fish, the 99%, versus let's say those who have traditionally been sort of had the privileged access to early stage investments, yes, with all the risks, but also a lot of times with the higher rewards. So what are your thoughts right now on where we are and also where we're going with that?
That's a great question. I don't know how I'm going to tackle it. Good morning, everybody. First of all, my name is Oscar Salem. Like Lisa, I've been in the market, probably the oldest guy here on this space. I'm going to confess that I'm not an expert in this field. I'm an expert in macro, so I'm going to leave you guys with two themes that I think are going to be very important going forward, and how those themes interact with each other. I think it's going to be the key to determining what kind of framework you use to invest. The number one theme, and I think the most important one, is the regime change we've seen in interest rates. And that affects everything, including crypto, including everything in the web. Money basically is becoming more expensive. Crypto, and Didi said something that's really, really important. He said he went into crypto 7 years ago because of the mismanagement of traditional investments. And he was absolutely correct when he said that. But the mismanagement came from central banks, right? Central banks have absolutely mismanaged policy, in my view. And I think that's important to understand. Money is going to become more expensive, and I think interest rates, the interest rate regime has changed. That is one theme. The second theme is technology. Technology is a game changer. We don't know what's going to happen in the future. Guys like me just don't know what AI is going to do, what technology is going to do, how that's going to develop. But I have seen a market very similar to what we're entering in, based on what I look at, which is price. And that was 2001, 2000 to 2002, right? 2000 to 2002, when the dot-com bubble burst. So I would be very cautious about being a retail investor in this environment. And the one thing that I'm going to leave you with is you basically have to know where your investment has gone wrong, right? Pick your entry levels, know where you're wrong, understand the framework that we're trading in, which is money is more expensive, interest rates have changed, and also you guys know more than me about technology, how technology is going to affect the future. But the regime and interest rates has changed, and I don't think it's going back. So I'm going to leave you with that.
Thank you very much, Oscar. Um, Great. And Noah, I'd like to invite you in as well to give your views on everything we've spoken about so far. Just yeah, introduce yourself as well and tell us why this topic is important for you.
Yeah, no doubt. Thanks for having me on. My name is Noah. I'm CCO of Whale Coin Talk, and Kyle put this on my radar. I don't know, like sometimes last year, you guys came on for a Twitter Space. I minted an NFT, and I don't know too much about VC investing. I've never been part of a VC. I've gotten dumped on by VCs quite a few times, especially in 2018, 2019. So that's probably my the closest experience I have with VCs. I just know that, especially in crypto over the last few years, if you got into any of those seed round funds, or rather seed round investments, or even private sale investments, it could have been quite lucrative. So I'm curious to see how Commonwealth is going to shift the paradigm. I do think that VCs, I don't know who was on stage that was highlighting the fact that VCs do have a breadth of knowledge when it comes to what to invest in. They are kind of organized and doing a lot of research and learning about what is the next big trend before they go ahead and invest their money into these projects. So I'm curious to know how Commonwealth plans to democratize that, but also keep it in a way where people are educating themselves on specific investments and are collectively deciding what they're going to go into versus what they might stay out of. Yeah, I'm be really excited, or I am very excited to see how this unfolds and how the community continues to grow.
Thanks, Noah. That's great. You might not be a VC or, kind of a seasoned investor in a traditional sense, but, you are a representative, I suppose, of a huge community of people who are in Web3. So I suppose you're a microphone for them, or megaphone, I should say. What do you think it is people are looking for right now when it comes to opportunities to like what do you think retail investors would say right now if you could like sort of channel their whole thoughts for this panel? What would they be saying to you or through you?
Yeah. Yeah, I think it depends on which retail investors you ask. So one of the things at Whale Coin Talk that I make sure we do is we're here as a podium for different projects, protocols, and solutions to come and showcase what they've built. And from there, we hope that our community members will make the best. They'll make the best investment decisions for themselves by doing the best research that they can. From my anecdotal experience and the people that I've spoken to in my circles, people are looking. People aren't looking for 20x, 30x's right now. I mean, let me rephrase that. There are a lot of people that are still looking for 20x, 30x's, especially people that are aping in the different meme coins. I get it, especially when you see something like Pepe do what it did in a matter of 3 weeks. But I think you have just as good of a chance at going into a casino and trying to win some money. Could be wrong, but that's kind of my personal opinion towards meme coins. But a lot of other folks that are in the industry, I think they're just looking for sound investments that might give them a big return in 1 or 2 years. But sound investments, something that makes sense fundamentally, something that they can see, you know, something that they can see as the next best thing in crypto. Maybe it's Web3 gaming. Maybe it's fractionalization of real estate with NFTs. Maybe it's some other NFT utility project. I also know that people are looking for stable farms, like 5 to 10% yield farms, maybe 20% yield farms. That makes sense. But that is kind of what I've gathered from talking to people in my circles.
Cool. And before we lose, I just want to ask you as well. So this is what the retail might be looking for, but also like retail as like a group of stakeholders or a stakeholder group within this whole kind of Web3 investment landscape. What is it you think retail can offer apart from just capital? Because VCs bring capital, but they also bring like a lot of different other stuff to the table when it comes to helping portfolio companies. Kyle, you alluded to it a little bit before, but maybe, Noah, what do you think, that kind of the opportunities are there for retail to add also to the investment process and the investment cycle?
Man, that is a good question. And off the top of my head, I don't think I have a great answer for you. I don't, I think one thing about the democratization of these sorts of investments is maybe uncoordinated dumping, or rather, not the lack of coordinated dumping. But as far as what breadth of knowledge or wisdom that retail would bring versus a VC, I don't really know. That's something that I've actually been scratching my head about, because I mean, I hate to say it like this, but I do think that an organized VC probably has more resources and tools under their belt, and they're able to better research and better forecast what projects will do well versus what projects won't. But that's what Commonwealth is here for, right? I mean, I'm sure you guys have an answer for this that I don't, but you're here to shift the paradigm, and you're here to find new ways that retail can be, can have an advantage over the traditional VC model.
For sure. Anybody else want to pick up the train of thought? The question there was like, what do we think? If retail is able to be more organized and the systems are there, what values do you think retail can add to the investment process?
I mean, I think everyone starts out as retail. So, I mean, what did I have, or Kyle have, or any of us have to offer to the market itself? We had to create that. That's the beautiful part of crypto. We can create our own opportunities, and that's what we need to teach other people. I've made many people come into their first project and like saw them flourish in this industry. But I think ultimately, to answer the question, it's helping them find out what they're good at. If you're good at marketing, well, crypto always needs better marketing. We don't have enough, right? Like, we don't have enough marketing companies. We don't have enough people to community manage. We don't have enough PR. We never have enough exposure. So anyone who works in that industry, already there's one avenue for coming in here. And then, creative people, creative minds, people like from education, like I was, who could make a really complex crypto project seem really easy for the other retail guys. So there's tons of space. I mean, anyone could learn how to be a trader. Anyone can learn anything, like Elon says. So, what value can they add? It's really up to them. Just like it's up to us to add value to the other ecosystem players here.
Anyone else have any thoughts there?
I want to just bring some attention back to the power of retail and the ability and just the amount of access, the amount of tools and time that retail has on their hands to dig up. Like, oftentimes the VC firm is, I don't know, between 4 to 25 people or something, and they're quite busy. But when you have a huge community of people all digging to find dirt they find it every time. And so in a lot of ways, I believe that Commonwealth will be way more effective at doing due diligence and digging up dirt and finding red flags than a lot of VCs are. And that's just the power of a community and a power of the ability that we have from blockchain transparency and people just to kind of, if something can be found, it will. And so that's pretty cool. And I also think that on the VC front, I forget who it was earlier that mentioned this, but there's not a whole lot of innovation happening. Like look at all of these L1s and L2s that are the exact same thing. They offer zero value proposition, but it's a VC game, and they're all just planning to dump on on the retail. They don't expect like these things to actually have adoption. There's no difference in Aptos and Sui and like all these different and all these layer twos. I mean, they tell you there's little slight differences, but they're all just doing the same thing. They don't provide really unique value proposition in a way that's really useful for the end users, for people. And so there's really not a whole lot of innovation, but you do see these big VCs who know that this is a narrative that can run, that if they put in a big check, they can mark up the next round, the next valuation, a 2, 3, 4x, and then they just make a bunch of money on this. And so I think that it's really going to be really powerful. The same kind of power, and this is what I'm really excited for to see from Commonwealth, is I'm anticipating the same kind of community involvement that we saw from Wall Street Bets, where you just see an enormous amount of people come in and really come together with the power of the crowd and call out bullshit together and rally behind really positive, innovative things. Like, what do we need? Do we need another layer 1 or layer 2 in the space that just offers smart contract functionality? Or do we need something that's innovative that allows, more people to come into the space and build really easy applications that people can use that don't feel like complex Web3 products? So I just wanted to shine some thoughts on that and why I think that retail VC, large community-based VC is really powerful.
Yeah, just on that note, Kyle, I think you're 100% spot on. I mean, also what the retail can bring to these projects. If a project needs introductions to centralized exchanges, or if they need introductions to web designers, or if they need introductions to mods and people to build a Discord, we will always have someone in our community that can fulfill all of these roles, and that's what the power of Commonwealth is. It's fantastic.
Yeah.
John, just introduce yourself quickly because you didn't do that.
Yeah, I'm one of the founders of Metaverse Capital and one of the founders of Commonwealth. Today has obviously been a really exciting day for us. We did our mint of our Gen 2, so it's been around the clock for the last sort of 48 hours trying to get things in order. But all in all, it's been a major success. I think we've minted out around 60%. Really excited and good to be a really, really cool panel of people here. So thanks all for joining.
Thanks, John. Carl, I've got a list of speakers want to speak. Lisa wants to speak, and then I need to invite in Ben from A195 and Mdali, or Michelle from Mdali as well. Sorry, did you want to say something? Go ahead, Carl.
No, just maybe guess. Yeah, go ahead, Lisa, or whoever just wants to speak. Go ahead.
Hey, yeah. So I just wanted to say, I run Getting Started in Crypto, which we have a lot of retail buyers in there, and just listening to like what you guys are saying. Obviously, people in crypto and retail buyers in crypto at the moment are a different market than what we're trying to attract long term. So when we go into a bull market, we're attracting, the people that just want to get rich. At the moment, we've got the diehards, we've got the people that are here for the long term, that are in there like to, build wealth and that sort of stuff as well. But they believe in these projects. They believe in crypto. And that's the difference between what we have now and what we are going to have in probably a year's time when we start turning into that bull market.
And Lisa, what is it? What is it you think the people now? Okay, we've said like the people that come in the bull markets, it's really hype based, right? But the people now, like, what is it that you think most excites and most what are they most drawn to about the space we're in? Because most people come in for the appeal of the quick buck, right? But what is it that right now is kind of the appeal, the attraction of staying here, grinding it out, all the days when the market is going down? Why do people stick around?
Investing, they're learning. So a lot of the people that are trading in this market are the people that are, learning the skills, honing their skills, because you learn the most about trading in a bear market. Anyone can trade in a bull market because literally it just goes up. You just like put a stop or a sell order and, you make some money. But this is where you learn the real skills. And I think that's why the people are here at the moment. We're seeing the projects that are coming in and you can really assess what they are. So I've got a magazine that I'm the editor for, the Moon Mag, and we have so many amazing projects come in. And, we have to turn them back because there's only so many that you can go, okay, this one's going to be amazing. This one's so different. And it's like we were hearing, it's like, which are the ones that are going to have longevity, are going to do something different in the market, solve a problem that sort of thing. And I think that's, what we're seeing in investors at the moment. They're sort of looking at those factors rather than just, the quick buck, because we are in a bear market, and those people that come in right now are not here for the, except for the meme coins. But other than that, they're not here for that quick buck.
Cool. It's fair to say that. Yeah.
Lisa, I must confess, I'm a subscriber to your signals, and they're absolutely phenomenal. I've been a subscriber for the last 18 months. So I really, really enjoy listening to your calls, and your analysis and your charting is really good. I'd like to give 10 free NFTs away to your community. I don't know how you want to do it, but you can just do it however you want to do it. So please just
awesome.
Send me a DM afterwards,
I'll
and that's great. Because I think your community kind of fits in really well with what we're doing here, and I think that all of the people that are following your calls are like really, really trying to make it in crypto. So I think for 10 of them to get a free mint would fit in really well with what we're doing.
That's epic. Love you guys. Thank you.
Thanks, Lisa. We've got a bunch of people wanting to speak. So who wants to go first? Didi, do you want to come in, and then we can invite the other speakers in?
I will keep it very short, because I think there's also two very important things that we are forgetting over here. Like, we are talking about VCs versus Commonwealth, for example. VCs, if we look at the retail investment power that we have, it's not only the investing, it's also the people that invest. Mostly are also influencers, etc. So we also have a big marketing advantage there when it comes to marketing in a niche market. So that's, I think, a huge difference between us and a VC. A VC is centralized and needs to hire marketeers. We are the marketeers and the investors at the same time. And I think that's going to be showing off way more power in the future. And the second thing that I think is very important that we completely forget to talk about at the moment is that retail probably keeps the money in crypto. A VC will take their profit, their quick buck, their quick profit, and will take it into their bank account again and invest it again in the traditional world. So it needs to be very important that companies like Commonwealth come here to have people invest in this new industry of cryptocurrency and then keep the money in cryptocurrency. Why would they send it back to the banks? Because that's exactly what we are trying to decentralize and disrupt in a big way. So I think that retail has a bigger chance of, when they make profits in their investments because of crypto, they will stay in stable coins and in crypto. And I think that's the biggest advantage that we can take power of as a community, because I think that's what we need to make Bitcoin and many other cryptocurrencies really succeed. That's the evolution. That's the peaceful evolution we all dreamed of when I started, for example, mining Bitcoin in 2013. It was a revolution, not only to making money, but also to build a new monetary system that gives access to the monetary system to everyone in the world, but also now to investments. My nephew in the Moluccan Islands that doesn't have a bank account can now invest and become part of Commonwealth and just participate in something really beautiful that he would have never been able to do in a traditional VC-based centralized banking world. So I think it's very important for people to understand this.
Thanks, Didi. So I'm going to invite Michelle in. Can you follow that, Michelle?
Hey, hi guys.
Mandali?
Thanks for having me. I'm Mike, or Michele, co-founder and CEO at Superfluid. I've been in the kind of tech startup space for over 10 years now. And for the last 5, I've also been angel investing quite heavily in fintech and Web3. So I've seen it all from a retail point of view, and also a little bit from the VC side, but mostly from the founder side. So maybe I could tag along with a bit of a founder's perspective onto this, retail investors being on board in Web3, but also beyond. So, we as a founder, we really care about who has a piece of the business in the early days for 2 reasons. First, startups are fragile. So strong investors that could really help how to build the business and get it to success are key. And secondly, because we want to make sure that we have an active investor base. And we don't want, just speculation to be the focus of these investments, because that could really jeopardize the business should a period of a downturn hit the business. Sometimes you have to go down to go up again when climbing a mountain, right? If you really want to go to the top. And if a short-term downward period triggers a massive dump of the equity or the token, could mean that the company will never actually see the top of the mountain. So we're really sensitive to that. And, it's not something new. For example, I live in London, and I was part of the early Monzo equity crowdfunding. And we've seen equity crowdfunding, accessible to retail for quite a long time now. And the real question is, how can we benefit from retail investors in the same way they benefit from early access to the company? And, if you're building, a rocket company that takes 10, 20 years sometimes and doesn't really benefit from retail investors, is a bit hard to assume that you will have, you provide access to this type of investment to the consumers. Whether if you're building, say, a fintech neobank, and retail investors could also be advocates, and they could be early adopters, and they could tell their friends, and you can suddenly have a massive user base that advocates for you. Then there is a very strong symbiosis and collaboration between retail investors and the company. So I would like to, to add this to the mix, that from a business owner or manager point of view, is essential to make sure that we align incentives such that they're all focused on the success of the venture. Sometimes we love to have VCs on board, not because they give us cash, but because they give us connections, they give us networks, give us resources that we wouldn't be able to tap onto if we were just to work with the average Joe. The other item I wanted to add is that it's a lot of work to invest in startups. Like as an angel, just going through a pitch deck is not enough. You need to know the team, you need to know technology, you have to understand the growth. It's a lot of work. I think, David was talking about it before. And not every person that, is going by with their life and family and work has really the time to spend like 5-6 hours on a due diligence for a startup. And that's why we have seen protections most of the time, because it's actually a risky investment. But yeah, it's been opening up. And I think, we have seen that as a trend where, is, step by step more accessible for retail investors to be on board. And yeah, as we have seen, DeFi opens up this even further. But the real question I have for you guys, and I'd like to throw it back to everyone here on the space, is because VCs are uniquely placed in the market to have very good deal flow, and because they have actually time to go through these companies, shouldn't we allow retails to be LPs to some degree of VCs instead, so that we remove the need for the retail investors to have to do all the due diligence and go through all of those? And so maybe syndicates are a good compromise because they do some of the screening. But yeah, what do you think about that? And how can VCs play a role here in opening up the market to retail a bit more?
Thanks for that, Michele. Sorry for botching your name. I thought it was Michelle. Pardon me. Really good. Yeah, I think let's ask Ben if he wants to comment on that, and also anything else you've heard so far, Ben. There's loads of tracks to pick up on, and then we'll sort of go around the panel again and hear more views.
Oh, great. Can you guys hear me?
Yeah,
Yep.
4 on 5.
Yep. Okay, great. Yeah, I'm Ben. I'm managing partner at A195 Capital. Been in the crypto space for 7 odd years, and like a lot of people, started out just as retail. And I think kind of what I'm seeing with Commonwealth now is kind of one of the reasons that excited me so much about crypto at the beginning. When I finally decided to take the deep dive in, it was really when there were the crowd raises in the early Ethereum days, where literally all you needed was some Ethereum and a wallet and a project that was raising that you were interested in, and anybody could participate. There really wasn't a huge VC game back in the day. There were a few out there, But really anybody who wanted to and had the Ethereum in their wallet just had to send it in and participate. And I just thought that was fantastic, where, somebody who was, sitting at their job, just had to plug in and would get the same round as somebody that was at A16Z or something like that. It was really kind of an eye opener for me, and a paradigm shift. So what I see now and how the space has progressed or progress or regress, depends on how you look at it. Over the 7 years that I've been in this space, is we've just really come into this almost a Silicon Valley model where you just have this select kind of gated community of VCs that get the top tier, earliest rounds of these projects. And it's, a lot of it is value add, networks, what they can bring to the table. And I understand it from a project side of things, where they want to have people on the cap table that are going to support the company, that can bring the money and be out of pocket on that money for, sometimes it's up to 4 years. It depends on what the vesting schedule is. And there's nothing that's guaranteed in this space. So it is a lot of risk. And as we've seen, what was perceived to be top tier VCs, Three Arrows Capital, et cetera, just really, anybody could blow up with improper risk management. So it's a risk. The job of a VC is to narrow that risk down as low as possible. Position yourself in a investment that you feel like you've narrowed down the risks as much as possible. You believe in the project, you believe in the team, you believe in the timing. Timing is also a very huge thing. And all of that together, that's the decision to go into to making the investment. And what I see with Commonwealth is one of the most important things in a project success is a community. And Commonwealth as a community could be very valuable for projects, because we're coming in as not just one name. Well, it's one name, Commonwealth, but there's maybe 500, 1,000, 2,000, depends how big this thing grows. People, essentially a community that's coming in and supporting the project. And I think that's a very valuable approach, not only for doing due diligence, but also supporting the project, getting word out, marketing. You just never know what kind of value add is going to come from the community when it's needed. So to me, that's really interesting.
Brilliant. Just to clarify, you are from the traditional sort of legacy VC space, and that everything you've said is that where you're coming from?
Yeah. That's where I have what I've grown into. And A195, a managing partner with A195 and GP and two other funds. And so I am in I guess what you would call, quote unquote, the legacy VC space. Yeah.
Ben, have you minted your Genesis 2 NFT yet for Commonwealth?
I'm in Genesis 1. So
you're in Genesis 1. You know that if you minted a Genesis 2 as well, there's going to be extra benefits. Just some alpha there.
Okay. Yeah, I've got a little strategy there. So I'll we'll wait and see. I'm going to try to gamify it here.
Tell us how you're going to gamify it. We need to close that. close the art.
That's top secret. Can't let that cat out of the bag.
Okay, everyone, follow Ben for his secret strategy.
On that note, Tim, maybe we could just clarify a bit of I made a video for Commonwealth, and but it's still being edited, so that should be out later tonight or tomorrow. But maybe we can clarify for anyone who's listening right now, kind of the role of the NFTs in Commonwealth, because I think it's really unique, and everyone's looking. When I've been on a lot of other spaces with Mario Space or whatever, and people seem to love NFTs. And it's the retail and common people, non Web3 enthusiasts seem to like NFTs, but they've only really been exposed to JPEGs, and anyone who's minted or looked at the Commonwealth NFTs can see that there's not really any JPEG aspect to it. They all look the same because there's no art aspect to what it's beyond. These NFTs have real world utility, and from talking about a VC aspect, essentially how these NFTs are working is that Commonwealth didn't raise money from VCs. They wanted to do it in a very community driven way, the same way that trying to open up opportunities. So if you have one of the Gen 1s or now I'm minting Gen 2s, it's exact same thing as participating in a seed or private round sale. Like, you are the VC. If you have a Gen 1 or Gen 2, congratulations. You've just become a VC already and got access to what typically is only afforded to a small network of people. And it's really interesting. These NFTs have not only do they act as a virtual representation of a SAFT, which is what a VC gets in exchange for their money, as a receipt, essentially an agreement that says, you give me some money and you're going to get some tokens later. So the NFT does do that, but it also acts in a way of equity or revenue share from the DAO as well. And so if you are holding one of these Genesis NFTs, Gen 1 or Gen 2, you are essentially one of the co-founders in a way where you do have part ownership in the project and the revenue that's being generated from it. And if you're familiar with the way that kind of fully diluted valuations work, I know that Gen 1 was at $11 million fully diluted valuation, which in my opinion is a very, very reasonable valuation for a project. And then the Gen 2, I don't know if the valuation is established. I think that depends on how many end up coming into supply. Is that right? Tim?
Sorry, I couldn't find the unmute. The way the value of the NFT works is it's always going to be $99 to mint, but the full allocation that's put across the collection is 22 million governance tokens from wealth tokens. So no matter how many are minted, the full supply will be divided by the end mint amount. So we don't know yet how many it will be. So it's really an exciting mint in that sense. So every day 999 will be available. Whatever is not sold or minted on that day gets taken out of the supply. And then the people who actually hold the Genesis 2 at the end of the 9 days will then know how many tokens they're getting, because you will take the 22 million that's been allocated across the supply and divide it by the total amount that's actually being minted. So pretty exciting stuff, very different. But thanks for explaining.
So that means that correct me if I'm wrong, but that means that the least amounts that are minted, the more valuable they become as far as a better deal that people are getting, right? If there's only, let's say, 1,000 of the 10,000 that are minted, then they're getting more tokens per each NFT, right?
Yeah, correct.
Yeah. So that's really interesting from like a game theory perspective, even to see how this unravels over the next 9 days here, where you could see something happen today, and then maybe you see a couple of days of slow, but then when people realize that like the supply is quite limited, it could get pretty crazy at the end too. It'll be really interesting to see how this plays out.
Anyway, if anybody wants more information on that, the tweet is pinned and on the spaces. You can definitely have a look there. Do we have any new speakers here? I feel like there's a few people that have just come up. Is anybody else who hasn't spoken?
Josh is here. Josh, you want to say something?
Josh, go ahead.
Hey guys, how's it going? My name is Josh Meyer. I am the managing partner of Andromeda Capital, and I think it's super interesting discussion here so far. Ben, I really like what you said about kind of the evolution of how in Web3 I feel like the crypto space has really evolved when it comes to venture capital. And, you look back in 2017, and prior to that, I joined the space in 2017. But prior to that and in 2017, you found that it was actually a lot more fair, I would say, for potential retail investors to come in. It was much easier for them. The way that the ICOs back in those days were done, just meant that, these big VCs, these big Silicon Valley VCs, for example, weren't yet really on the table and they weren't really contributing. But in this last cycle, what you saw was that the larger amounts of money and the big funds from Silicon Valley, the A16Zs of the world, they started coming in, and without a doubt, they start swooping up a lot of the best deals and the best valuations. And that added a whole new dichotomy to the investment game for Web3. And on one hand, I do understand the value that some of these big VCs have. I mean, they have incredible networks. They have the ability to help really push the product out there. And on the business development side, they have some really strong advantages. But at the same time, I think a lot of people underestimate the power of the collective. And what I mean by that is a lot of people underestimate a large number of individuals that are all investing in a DAO-shaped formation, kind of, let's say what Commonwealth is looking to do. Because when you have a large group of individuals all set up together with the same goal in mind, you never know how crazy some of these people's networks might be. Someone's uncle might just happen to be the exact person that can bring this project to the next level. So I've seen it in many times now where in the community of a project, it ends up being one of the most influential or important introductions that comes from a total retail investor, just because he happens to know one person that could really bring a project to that next level. So very excited to see the future here, especially with some of the new regulations that are coming out, especially on the USA side. So it'll be really, really interesting to see how a trustless and a non-custodial system is going to do to really evolving this DAO-shaped world.
Just for those who don't understand, Josh, maybe Kyle, you can explain how Josh is referring to custodianless and also permissionless when it comes to this DAO. Because I know VC DAOs are not a new thing. We've referred to them quite a few times in the spaces today already. It is one of the sort of innovative ways we have seen that sort of Web3 has enabled a different take on how to invest. But if I'm right, Josh was referring to something that's completely permissionless and also non-custodial, which VC DAOs are. So maybe Kyle, you just want to clarify something there?
I don't know that all VC DAOs are, and I think that a lot of VC DAOs act in the form of a syndicate, right? And that's not necessarily custodianless or permissionless or trustless either. A syndicate typically they have a deal, they will get a staff or an allocation to a project. The community will all have an opportunity to throw in money, or it's first come, first serve. And then usually whoever's managing that syndicate is going to be the one who ultimately is the custodian or the trusted party who's managing that deal on behalf of the community. We saw this in 2017 a lot, and there's a lot of good syndicates out there that gave a lot of good opportunities to their community. And then there was some that just raised a bunch of money in the prime of it and then just disappeared as well. And I think that's always a risk, and we need to start looking how to go into the true Web3 ethos of not your keys, not your crypto, and to also be very, very cautious on who you're trusting to custodian your funds. So Commonwealth is being built in a very trustless way where there's never any centralized custodian of your funds. Everything's done in smart contracts, autonomously in a protocol. One thing that I think is very, very important to understand is that Commonwealth is an autonomous protocol where everything is built into the code. It will be open source. Everyone can audit it and look at everything that's being done. So you never have to trust anyone with your funds. When you put them into a fund, that's being held in a smart contract, and that is being only deployed per proposals and passing proposals. And then once the redistribution comes in, everything is done autonomously. And that is what makes Commonwealth really special and really unique in the building process, and why it's been taking so long to build, because it is intricate, it is detailed, and this thing is meant to be censorship resistant, meaning that it cannot be shut down. And once this thing is released into the wild, it's just operational, and the thing runs itself. And again, I know that people like convenience a lot, but even when you're doing things like yield farming or something, is it really worth putting your money into a centralized custodianship, earning a small percent of interest when your whole balance could go to zero, and things like FTX or Celsius or whatever? So I really love that about Commonwealth, is that you really can trust code. You have to trust humans.
Thanks, Carl. Who's new on the panel wants to come in? I think Bull Run, you've become a speaker here. Great to hear your views.
Hello, can everybody hear me?
Yes, 5 on 5.
Great, just wanted to make sure. So thank you for inviting me, having me on here. By the way, happy Bitcoin Pizza Day. I just saw the date. So quick background on me. I came into crypto in mid 2017, simply as an investor and a community member. I do have somewhat of a background in traditional finance. I'm probably one of the older guys in crypto. I feel like the granddaddy of the bunch sometimes. I'm in my late 40s. I do come from somewhat of a traditional finance background. I did have some time I spent at Morgan Stanley. So my experience was around people on the trade floor. And that's kind of what got me the itch to enter the scene in crypto. It was the opportunity and the adrenaline and the excitement of being in an emerging technology and field. So with that has come about 6 years of experiencing the change, not only in the technology, but in the landscape of crypto. And with that, obviously, has come some stringent regulations. And being from the United States, I've witnessed that firsthand. And that has always been, not only a concern, but something that I feel like we need to adapt along with that. People who have come into crypto have been somewhat of since I would say it's a newish technology, a young technology, and a young field. A lot of the investors are young and somewhat inexperienced. With that, especially back in 2017, 2018, there was a lack of education. People were throwing money into investments without really understanding what they were investing in, and not really knowing what the pitfalls and dangers were and the risks. So people were over leveraging themselves, throwing more than they could afford to lose into projects. And obviously, a lot of people lost money, got frustrated, and left the industry altogether. What we've been able to accomplish over recent years is a better or more opportunities for education and responsible investing. And I'm the co-founder of Moon Boots Capital and of EC2. And really what we prided ourselves on were we came from the background of being investors and community members. And we tried to, so what I'm saying there is that there's a lot of synergies between where I came from and what I do now and what I see in Commonwealth. And that's turning a lot of the power over to the community members and giving them not only education, but more control over their funds and more transparency. When you talk about Web3, some of those core values are being permissionless and trustless, and that's extremely important in this environment. There's there's too much pull from centralized entities that kind of undermine that ethos, and I think that's something that we really need to take a hard look at, even when it comes to DAOs. So DAOs obviously pull, guide people away from that centralized mindset and give the members, the vested members, more say in the direction of something, of that particular project, or that particular community. But at the same time, it's got to be responsible DAOs that know that what you code in the voting apparatus needs to give people power, but not irresponsible power to make decisions on behalf of that entity that could actually, ruin ruin that particular community. So there has to be somewhat of a balance when it comes to that. And again, from what I've experienced in the past, people came in with a bit of a casino mentality into this field. Meme coins are certainly a good example of that, but there was kind of a difficulty for people to mentally separate the fact that it is, highly volatile, it's not risk averse, and people would dedicate too much capital into high risk plays. So I always lean back on properly educating the community and helping them understand, as newer investors and new to this field, that you need to be responsible with your money and how you diversify your investments. Smaller percentage of your capital should be allocated to different projects. And then I heard somebody mention earlier the concept of and it's being done, insuring your investments. And I think that's big, because when you talk about, people don't like, especially in this business, the talk of central banks. But one thing that they do provide is your funds are FDIC insured, right? So that can't happen here, but you can have processes put in place or opportunities put in place where people can insure funds, and that's I think that's critical going forward, that people have opportunity to purchase insurance on their funds. We saw what happened with FTX. We saw what happened with Luna. People lost a lot of money, and some people were financially ruined. Many people were financially ruined. And these are just the changes we need to make going forward. It's an evolution. And what I see in Commonwealth is that that movement, that evolution going forward, to make the field more accessible and give more control over to the common investor, and at the same time educating people so they know how to be more responsible with their money.
Thanks so much, man. It's a total theme developing here in terms of, like, yes, the access is absolutely phenomenal, but there needs to be that education element. And I think you mentioned the word education maybe 6 times in what you just said right now, which is fantastic. Listen, yeah, you got a great audience there, I think, who probably would love to hear about Commonwealth as well. So if you do kind of align with what Commonwealth is doing, I think it'd be great if you can also let your community know if you haven't done already. Thank you. And there's a great tweet went out there from Whale Coins. Thanks, Noah. Looks fantastic. Thanks for the support, man. Next speaker up is Comb. Sorry for keeping you waiting for so long, but please unmute yourself and tell us what you think about everything you've heard so far.
Yeah, so my name's Moon. Comb is a yield aggregating and yield optimization protocol based on the Phantom Network, and we focus on 2 things: user experience and capital efficiency. And so, thoughts on most recent things. We've kind of deviated to VCs, but I think the one thing that's really notable about everything we talked about is probably like the community aspect. Something that has really helped us from a project standpoint. The community is probably the number one thing that needs to be fostered for any protocol to kind of live. And to build that community, it does require a lot of trust, which is something that is probably the most needed within the crypto space. Although user experience is great and product design is great, the whole sentiment behind crypto is probably the one thing that is keeping people back from actually investing or being onboarded onto the industry. And looking into it, the community is the number one thing you need. I mean, the fact that it helps you build product market fit, get feedback, interact and engage, and is the one thing that crypto has best in its industry compared to other industries out there. And so hopefully as we build forward, we can focus on actually building these sentiments positively for crypto, because yes, there are a lot of restrictions. The fact that people are losing a lot of money, education does help, but I think that begins with the sentiment in building out the positive sentiment for crypto. I guess throwing out a question for the audience here and the speakers, how do you guys think that sentiment or the negative impact of it affects how it, I guess, since we are talking about VCs, affects like these VC DAOs as well? That little sentiment there.
Repeat the question there, just in case I didn't catch it. How does the negative sentiment affect the VC DAOs? Which negative sentiment exactly?
Like engagement in crypto. And so a lot of crypto, I think it's been riddled with rugs and just lots of, bringing back to the previous speaker, how the crypto feels like gambling. I think that's something that's still rampant on the whole sentiment of actually investing and putting your money into the industry. And a lot of uneducated individuals will eventually do that in the hopes of making high returns fast. And doing that, it does put a nasty taste, because one bad turn in your whole experience in crypto will probably just kick you out of the entire industry. That's one of the scariest things to happen, and one of the negative things of the industry. And hopefully one day we could solve this. But yeah, I don't know if that question really resonated through, but
yeah, I think it came through. Does Ben or Michele want to speak to that, or maybe James?
I could speak up there. I mean, my personal opinion is that we need self-regulation, and so in almost every industry in the world, there's best practices and standards, and that are followed by respected companies. You know, you wouldn't be able to manufacture pharmaceuticals or create, a clean cooking environment for food, or how you manufacture goods and things like that without standards. And in this space, unfortunately, we don't have any standards yet, or even best practices that are widely recognized by the industry. We need to self-regulate. And everyone right now is just looking to regulators who don't understand the space whatsoever. And the best thing that can come out of national regulation from states is just the ability for enterprises and institutions to come on board. But if we want to prevent the rugs and the catastrophes and the centralized exchange theft, we really need to self-regulate and create best practices and standards that you recognize. If there's someone who sets up something, let's say, for centralized exchanges or DEXs or whatever, and say these are the minimum basic things that these companies should be doing in order to assure, the most kind of security for their users as possible. They're following these kind of best practices. And so, we're working on something for one aspect, but this needs to happen widely across the industry. And I think that for anyone listening who is looking for a good idea, this is something that could definitely work. We saw one instance where this became very prominent. This was the proof of reserves and exchanges. The first time that there was a demand from the retail to show, and even then there wasn't a standard that was agreed on what is the best proof of reserves and how do we actually assure that there's liabilities and things like that. But the interesting thing was, if you were an exchange and you didn't try to do proof of reserves, you were going to lose all of your customers. And that was powerful. It was a demonstration of how powerful best practices and standards can be. And that's how I think that our space evolves and matures as we go forward. We can't, we're a global industry. We can't expect, state regulators to properly regulate the space.
Anybody else on the panel want to reflect on any of that, what Kyle said, or any of the sort of threads that have been emerging throughout today's spaces? This is the All Street Beat. It's our first episode. We're discussing what the future is in retail investment. There's been a lot of diverse opinions, a lot of good exchanges, but also some really, really clear red threads in terms of we definitely need innovation. There is some innovation happening. Potentially not enough innovation. However, Commonwealth and a lot of other examples are really trying to provide that access through innovation, through leveraging the decentralized technology. But we do realize that education is vitally important in terms of being able to uphold the standards, and then also giving the community the right and the voice to be able to push the standards, like Kyle just said as well. Michaela, you wanted to come in, and then I'm going to invite James. So Michaela, then James. Aurora also has the hand up. Let's do that. Michaela, Aurora, and then James. Go ahead.
Yeah, so I feel like blockchain technology gives us this unprecedented ability to coordinate action at scale through, game theory and incentive structures. And so, when it comes to investment, I think now we have a coordinated structure to have the world invest in what we deeply care about the most, right? As retail investors and users. So we can just coordinate funnel all this energy to the projects that we believe are the most impactful or the most, that provide the most ROI. So, as any other panelist was saying before, the power of communities comes across with a different voice, right? Because it's a public infrastructure that can show the donations and channel funds to aid the best projects out there. So I think that we should not underestimate communities and the power of communities to boost the type of projects that we like to see. We have seen that over and over. That's how Ethereum got started in the first place. And hopefully some of the best projects have been thriving so far, mostly through community efforts. So I think that, it empowers individuals to a different level than before. They could also claim, engagement or actions because of on-chain records. They could contribute and then prove the contribution, which is quite powerful. And education also plays a role there, where, we can, as a very bare minimum, by simply educating others on the projects we are invested in, we are acting as ambassadors for those projects. So I think it adds a completely novel dimension to retail investments. And I'm very, very keen to explore how far communities are going to take it in the blockchain world, because it's kind of the ultimate power given to consumers to basically channels the action where it needs to be.
Brilliant. I'm also interested if there's limits on that, like theoretical or real limits in terms of the technology and how far that can scale. Aurora, you've been waiting patiently, and then also James been waiting patiently, and we have Acti as well. So we got 3 more contributions to come up. Go ahead, Aurora.
No, appreciate it. Appreciate the invite up here. Just to reflect on something that I'm a huge believer in that Kyle mentioned earlier, right? Like, I don't know, a lot of people speak about regulation like it's a good thing. I'm not a huge proponent of that. I think that regulation is ultimately a bad thing, and that we need to find better ways of regulating ourselves to fix our industry. But I think one of the main things that I really like about Commonwealth, and one thing that I definitely saw in the last run, was this massive disparity, mostly caused by knowledge in between the people who are getting involved in IDOs and helping some of these products come to market and a lot of the VCs. And that's the main reason why I love what's going on right here. Because I think if we can close that gap a little bit and make it a little bit more fair, and I know ultimately it's sad that we measure technology based on its chart, but if you want to be completely honest, we really do. You know, the interest, the amount of people who are getting involved. It's sad, but unfortunately they follow green lines. So if we can just create more equitable circumstances where people are able to get into these levels of participation earlier, because my next thesis for the next run is that retail is going to be smarter. I think the next run is probably on the way myself, and other people have different opinions about that. But the main thing that we really need to fix, and the reason why I love what you guys are doing at Commonwealth, is close some of that disparity gap in between the people who are getting in super early and then allowing retail to get in super early. Because I think in order to build really good fans, you've got to give them an opportunity to get in the ground floor and to be able to participate, as opposed to just simply being dumped on by. And don't get me wrong, I've participated in venture capital myself, but I think that one of the main gaps that we really need to close are these equality gaps, and then some of these knowledge gaps, and just some of the asymmetric information. Allow more people to get involved on the ground floor, and I think that that's ultimately is one way of kind of regulating ourselves. Just to spin back to that first point, in the sense that if we can just make things more equitable, more fair, we need less regulators, less gatekeepers, and things are just kind of programmed as more equitable from the beginning. I think it'll do a lot to really help the industry. That's all I had to say.
Oh, that was a brilliant, a brilliant but short but brilliant intervention. Thanks a lot for that. I heard let's get rid of inequality gaps, or equality gaps, even information gaps, less gatekeepers, and I heard that retail is going to be smarter. So it's just about having the right tools, then I suppose. Brilliant. What did I say? The order was going to be, I think it was going to be Acti now, and then James, or James and then Acti. Whoever's ready, just go for it.
I'm ready to speak, Tim. Can you hear me?
Go ahead.
Hey,
Five
guys.
on five.
Hey guys, James Willie here, founding partner of Metaverse Capital. Pleasure to be here on the All Street Beat. Had a good morning minting some Commonwealth NFTs, so it's been all good. Just to follow on to what you guys have been saying, like I wanted to talk about, like the sustainability of the industry going forward, and specifically from like a VC standpoint. And I wanted to touch on the vesting schedules. Obviously, in the past, there's been different vesting schedules proposed by different projects. And, in some cases, as a VC, we might have got, big unlocks early and done big multiples and, sold into the retail who ultimately got wrecked. And ultimately, that project didn't do the type of multiple that we hoped for because, it wasn't sustainable. There wasn't enough buyers in the market, to kind of keep it going. And I wanted to just ask a question to, Commonwealth and, maybe get some other comments on it from other guys in terms of how they think vesting schedules should look. And I wanted to ask Commonwealth how they're going to be handling the vesting schedules for the projects that they get into going forward. Like, is it going to be, are they going to be selling tokens? Are they going to be holding tokens? Like, what's kind of the plan around that? And how do they see that creating more sustainability for the market over the longer term? Yeah, that's it. Thanks, guys.
Kyle, if you're with us, do you want to respond to James's question about the vesting, and then we'll ask Acti to come in?
Sorry, I was responding to. I didn't hear the question.
The question is how is Commonwealth going to deal with the vesting schedules, and managing the liquidity and managing the sale of the assets
that the funds invest into from Commonwealth. So this is a really this has been debated quite a bit, and what I've seen in different DAOs, when you leave a lot of discretion up to the community, everyone's always going to be divided, and it's going to really tear down a community. And so, and for things to run the most efficient and for them to run in an autonomous way, everything needs to be automated. And so Commonwealth, along with project founders, need to come to terms with an acceptable vesting schedule. And the projects need to understand that Commonwealth is going to sell the tokens according to the vesting schedule, and that's just protocol. It's not a personal thing. It's not that we don't like you. We do like you. That's why we're investing into you. But this is how a protocol operates. And this removes any type of community discussion and discrepancy around all the controversy that could happen when and you know, we're okay. Also, I think it's okay with things like longer vesting schedules, right? If you have a 2, 3, 4 year vesting schedule and you're selling consistently over that period of time, you're going to sell some into a bull market and some into a bear market. But it has to be autonomous and it has to work. Now, some people might say, well, a project is not going to like this. They're not going to be happy that you're going to be selling their tokens. Well, vesting schedules, project founders need to understand that vesting schedules are created by them, not the VCs. And so you need to decide what is acceptable for you. And it should be the right of investors to be able to sell those tokens when they are unlocked. And I think that the value that Commonwealth will provide to projects will be so immense. There'll be so much value added to them that will be acceptable. They'll understand that, hey, this is just protocol, this is rules, and everyone is upfront and transparent about the way that things will operate. You know, so no surprises here. But that's what we've decided so far, as far as trying to keep the community aligned and harmonious. This the last thing that we want is a bunch of drama inside the community, because it's always going to be half the people thinking that they should sell now, and then half the people think it's going to be a moon bag and they should keep it for later.
Okay, great. Thanks, Kyle. Coach has got his hand up. Aurora's also got their hand up, but I still want to bring in Acti. So if I can bring in Acti first, and then I'll bring in Coach afterwards, and then Aurora afterwards. So go ahead, Acti. Just tell us
Thank you.
a little bit, a quick one about yourself, and then pick up on any of the threads that you think are interesting.
Yeah, thank you. Thank you so much. It's been great listening in, and it's great to see what you guys are building, to be honest. I'm a colleague of Noah's. We're part of Whalecoin Talk, and we like to educate the masses with what we do. So, but I was listening in, and it reminded me of a space that CZ did, I don't know, maybe a year ago, where he was actually trying to point people towards responsibility, towards self-custody, towards using an exchange responsibly, and calling attention to all this greater DeFi eco space and the risks involved, right? And getting people to pay more attention. And the first question he got, right, was somebody that was frustrated on why isn't it easier? Like, this space has been around for so long, just been so much talk, so much news and everything going around. And why isn't it easier? Why do I have to self-custody? Why do I have to do all of this? Why can't somebody else take care of this for me? So lo and behold, when we were talking first with Kyle, Noah mentioned this earlier, we had no idea what's being built. But seeing what you guys are building, it makes me think that maybe some of you were in that space and figured, you know what? It would be cool to actually build this and not just onboard the new whatever billion users, but actually offer something cool for DeFi users altogether. Because something else that we did with Whalecoin Talk, we reached out to universities, we talked to blockchain clubs, we talked to teachers and educators, and these new people coming in, they are aware of all the tools, right? They're builders. They want quick access. They're not scared of using new things. And if you can bring curated experiences to them, because this is what it will be, right? Everybody joins the Web3 space mainly to sort of profit in some way or another, whether you're selling services or an investor or trying to innovate, you're looking for their profit. So these new people coming in, they have more access to information than we ever had getting started. They're hungrier than we are, and they're not going to be your 2x degens, your whatever collectors. We'll see some of those, but some of these new people, they're highly educated, they're looking for good products, and they are going to see when a team and an effort by some experienced people in the space is being put forward to actually build something useful for everybody. And maybe we'll get to grandmas and grandpas too, but I'm excited for what the Commonwealth's doing, and it's great. It's been a great space. Thank you for bringing me up, and I'll happily listen in. It's great to see everyone and the progress that you've made, and I'm keeping my eyes on those mints. I'm already a proud owner of the Genesis one, so I'm very happy to have been involved with this from the very start. So really excited for the future for Commonwealth.
Thanks so much. It was a great intervention. Brilliant. Who was wanting to speak? The hands have gone down. Coach, your hand went down. Aurora's hand went down. Is there anybody else still on the panel that hasn't spoken? Oh, the hands both went back up. Coach, go ahead.
Yeah, I just want to talk on the vesting schedule side.
I've helped a lot of projects with tokenomics, and this bear market, I kind of went back and looked at all the different schedules and all the different types of vesting that we did with cliffs and everything. And a resounding effect that actually I realized is that most of the projects that have these long-term vesting schedules start on a massive high because there's hype around the projects. They do 100x, 200x, 50x. And then the VCs and the retail and the influencers, everyone looks at it and goes, wow, this is really high. There's a lot of tokens coming out in these vesting schedules. And usually these projects don't have their product complete. So everyone sees this as like, I don't really have use of this token. And I feel like that's why they have such massive dumps to the point where they look like someone died in an emergency room. And I think something that I've learned from all that research was the faster you give people all their tokens and let them get through their selling off and making their little bit of profit, you don't rise as fast and as hard, but then you have a gradual rise if your product comes out and it works, because there's no one else having the ability to sell off on you, whether you're another VC, retail investor, other etc. So that's something really interesting. And another thing that I tried with Eternity and a couple other projects was giving the VCs and the retail the same price per token. So not a different valuation. Everyone buys in at the same time. VCs can get bigger checks. Retail can get smaller checks. But in the end, everyone's paying the same price, which naturally creates a floor. So those are two things from investing schedule perspectives that I've learned is that, there are ecosystems. If you're in a layer 1, layer 2, and lots of stuff are building on you, there's probably going to be more and more value added. So probably a longer vesting schedule makes sense for those guys. But still, I think the dumping and the VC dumping everything, it's just people looking mathematically at, there's 5% in supply right now, there's 95% coming out, or there's 10% out, there's 25, and they know that those values are going to drop because it's like printing the US dollar. The more you put in circulation, the less value it has. And so, it's a natural phenomenon for people to sell off those first initial investments, but also for retail to get hyped up and buy in. And I think that's a really inherent problem in our industry, because if you give people all their tokens, the dumpers are going to dump. For the most part, they'll be out, and it gives you time to build your product, and you're not spending tons of money every month trying to make the price back up, because that's what you basically need to do to get the project really flowing before your product and everything from the utility side is there. So it's just something that I'd like to share as a perspective, because I feel like a lot of people don't look at it that way. And I find that's a lot of the time what's failing the projects, because their liquidity every month, they put in their 500K, and then every month people get distributions. And if they're higher value, they're going to sell. And that liquidity gets drained to the point where good projects basically say, there's not much we can do other than raise more money. People say you failed. They don't give the money, and then they fail. And a lot of good projects fail in our space too. So I've been trying to help projects understand that aspect, how to think about it a little bit better. You're not going to do 100x, but everyone's going to give all their tokens. You might do a 5, 10, 15, 20x, but it's really a 5, 10, 15, 20x on the actual value of the token versus a fully diluted value, which doesn't really count. So that's just something to think about in terms of tokenomics and in terms of vesting schedules that I've really been trying to help VCs, projects, other influencers, and just retail understand, because if people went back to the old ICO model, we gave 100% of tokens, but I feel like that just worked better for the retail investor. And all these vesting schedules, it feels like the VCs kind of took over this last cycle, and they wanted all these different things. And I was trying to adhere to that, knowing what I'm telling you right now is that giving all the tokens out removes all the sell pressure. And it lets the project focus on not what their price is, but what they're building. And so I'd love to hear your guys' opinions on that. I've had told this to a lot of VCs privately, and they've agreed, and they want to do something like that together. But if anyone has opposing views, I'd love to hear that, just because I feel like the research has backed me so strongly now that I'm convicted. I want to hear other people's opinions on it.
Coach, we might get a bit too specific on this topic. I just also want to allow Benjamin, who's just up on the stage, to unmute and say hi. Benjamin, you haven't spoken yet, right?
Yes, hello. Thank you first for having me on this Twitter space. But I have to say, I'm right now in a bus, so I think it will not be very comfortable for me to speak right now. But I think 25 minutes, I will be sitting in a different kind of environment.
Okay. Next time then, Ben. Aurora, over to you.
Yeah, sorry, I'm not going to take up too much time. I just wanted to comment briefly on a couple of things that Coach K said and just say I'm in absolute agreement with what he outlined there. I think there's a lot of power in getting your tokenomics out there and having 100%. I guess the main hesitation with VCs is all of a sudden you have this higher FDV, right? And I think like that's kind of why a lot of people stay away from that initial like the initial fully diluted value, let's call it, so initial circulating. But I think that in another way, I've seen that be really, really incredibly effective. So like I'm in complete agreement with Coach K. The number one issue here are the vestings, but I would also, as a caveat, mention that there's a way to be able to circumvent this, and it's really basic. You know, it's pretty hard to get mad when Sequoia or somebody like that got into a round, you know, got into a seed round, and they got their you know, let's just say hypothetically speaking, they got their tokens for 2 cents, and all of a sudden I can go over and I can, you know, get another little piece. Maybe it's only, you know, $300 or $400 worth, but I get in at the same price as them. And I think one of the things that a lot of people, a lot of VCs, and a lot of people who are building projects really overlook is like the power of community and the power of micro influencers. Obviously, you know, like there's a bunch of influencers on the stage that I know quite well and have worked with a ton, and I'm a huge proponent of. But there's a lot to be said for giving an opportunity, if you are going to do a vesting schedule, for giving an opportunity for the little guy to get in. You know what I mean? And make some noise. I think micro influencers are largely the way of the future, and I think you'd be surprised at how much effect you can get when you get somebody who's legitimately excited about your project in at a really, really early stage, and have an opportunity to participate at the same rate as a lot of the big guys. And just to kind of, you know, just to launch off of what Coach K said, I agree with him. They don't need, you know, you don't need to give them $50,000 tickets. They probably don't want $50,000 tickets. They just want the ability to get in there and to get a little chunk early, and to be able to go out there and scream. And those are the kind of people who are going to scream your name from the treetops. You know, these are like the little micro warrior, kind of like ninjas who are going to be out there just talking about your product, excited about your product, tweeting constantly about your product. And if you have, you know, 100 of those guys, or 200 or 300 or 400 or 500 of those guys, I think that a lot of VCs probably underestimate the effect that has. And just generally speaking, I agree with Coach K. After working in kind of a lot more grassroots launches, I think that just getting your tokens out there, getting that FDV out, is really going to help improve the look of your chart. And as much as I hate to keep going back to the chart, we all know how this industry works, and then, you know, we know people are kind of like flies. They see a nice chart, they get interested. Unfortunately, it's kind of like a lot of the mentality leads with that, you know, money first, tech second, but it's all intertwined at the end of the day. So just quickly saying, I think that getting people in early is really going to help. I think allowing people to be part of that mission on the ground floor is really going to help. You don't have to give them huge tickets.
Thanks a lot, Aurora. Guys, I think we're maybe coming towards the end of the space. I just want to say to everybody who entered the competition, you will be contacted. The winners will be contacted. So thank you very much for that. We're not going to have time to be able to do that right now, since we've run over time. But Kyle or anybody else want to give a last thought before we close up?
No, I'm good.
Cool. Well, then I'm just going to say thank you for everybody for joining All Street Beat. If you like what you've heard, we'll be doing episodes regularly. You know, stay tuned for the next announcement of the next All Street Beat. The show will continue to digest and dissect everything that's happening in investment in Web3, and you know, continue to bring insights that will, I hope, allow people, individuals, the 99% mainly, to have more successful experiences when investing in Web3. Commonwealth is a tech platform that's being built, has been built largely, will be coming to market very soon. That will allow the 99% to have the same access to retail, or to early stage investment opportunities like the VCs have had, like the entrepreneurs have been able to access, like the sort of privileged privileged few have been able to access for, you know, a long time, whether it's Web2, Silicon Valley, or now also in blockchain and Web3. Commonwealth is solving this problem of access. It is solving the problem of, you know, retail being the exit liquidity for these people. and evening and leveling the playing fields. Everybody is invited to become a founder of Commonwealth. There's no preferential access when it comes to who is funding and who is actually becoming a founder of Commonwealth. The Genesis 1 NFT was sold out 2,000 out of 2,000. The Genesis 2 is now being minted right now, in fact, and for the next 9 days. Whatever isn't minted is taken out of supply. It's a very fair system, really fair launch, and also a fair fundraising for Commonwealth. If you are a Series 2 or a Series 1 holder, it means you will have Genesis, or you will have access to Commonwealth's governance token. You actually get them put to your wallet, sent to your wallet. So you are in fact an owner of the governance token if you buy one of these Genesis NFTs. You will also be given protocol profit share for life. So if you have one, probably good to know that it will you will be entitled to access to profit share for life from the protocol. So if Commonwealth protocol is becoming more valuable and generating value, the excess value, the profit will be kicked back. A proportion of that kick back to the Genesis 1 and the Genesis 2 holders. So yeah, go out, and if you like Commonwealth, you want to become a founder of Commonwealth, you want to govern Commonwealth in the future, then please, this is the earliest and best way to do it. After this Series 2, there'll be no more Genesis NFTs ever in supply. Thanks everybody for joining All Street Beat. Looking forward to having you on here in the future, and have a good the rest of the day wherever you are. Thank you.
Thanks everyone. Bye-bye.
Thanks, guys.